Welcome to the April 14th, 2025 Advanced Report for McGowanGroup clients and NetWorthRadio.com listeners. We've got absolute market chaos and volatility. I'm going to take you through where we are, what we're doing about it, and some strategies, lessons from the 1970s, 80s, 1990s, and the 2000s. How did we recover to record profits in the 1990s example, in the 2000 example? How did we actually make money while the Dow had 12 years in the desert? And that's the conclusion, which is going to have some great lessons. This is clearly a bear market. We are looking right here at the NASDAQ. It took a huge bounce to get it to a minus 12. You see this low right here. That was more than 20% down for the year and significantly down from this peak. That would be near 30% from the peak that we saw in February. That is a full-fledged bear market cycle. Now, the tariff chaos will lead to a few things as we go through this, and I'll cover that as we go. This was a huge bounce on the news that for everybody except China, we're going to pause the bigger tariffs and negotiate with the 70 countries that wanted to. What does that mean? That actually means that we're going to get some positive news, right? But you're going to have huge disruption in profits. There's the S&P 500, currently down about 10% depending on the hour because we've been getting swings. This week's volatility in the Dow and the S&P was well over 10% from the trough to the peak, with moves significant each day, 4, 5, 6%. That is fast and loose trading. Well, the tariff negotiations and successful agreements will be positives going forward. What's the negative? All right, I want you to picture the Pacific Ocean. There's like millions of rubber duckies built in China on a freighter, on freighters, waiting in those cargo ships because you got a 125% tariff. And then you got more ships with Buzz Lightyear and Sheriff Woody dolls that you can't bring into the United States. So they don't make it to the Walmart shelves and people can't buy them. That's a supply chain disruption, and it's likely to mean recession, which was the title of today's program. Recession, bear market, and maximum fear. There's the fear-greed index, and right now it's about a 3, which means extreme fear. 100 would be perfect euphoria, utopia. We'll probably never get there. But anyway, we're in extreme fear. And, you know, be fearful when others are greedy, be greedy when others are fearful. We're finding great bargains, categories. High-yield bonds, right? I can get a cushy high yield, 9, 10%, 8%, and I can buy bonds at a discount because everybody's scared. And I'll show you the 1980s, 90s, and the 2000s where we recovered from the 2008 in 9 months after that inflection point when the whole U.S. banking system was insolvent. In any case, earnings estimates are going to go down. Walmart's not going to sell as many rubber duckies as Buzz Lightyears because they're stranded out in the Pacific Ocean, right? That says, wow, you got to adjust for some earnings adjustments downward. Company announcements are starting this week, and you want to watch those announcements because they're likely to lower forward guidance. That cascade, I think you've got 3 potential waves of selling. This is wave 1. That's the Dow Jones Industrial. Oh, this is crude. Crude got smacked because everybody's building in a global recession. All of the longs, which are generally consumers like airlines, they took their long trades off and boom, you smacked oil down as low as 55, bounced back over 60, and it's changing by the minute. Those assets, though, in energy infrastructure, you could get yields of 5, 6, 7, 8% in pipelines that are trading between 2 and 7 times cash flow. It'd be like buying a rent house. You pay 5 times cash flow, that's 20% net rent to the owner of the building. That's some pretty darn good real estate that's on sale right now. And you take the high yield bonds, you can make enough money to pay the bills, and if you're still working, you can reinvest that for more powerful income later. That was a key strategy in 2020, a key strategy in 2022, and picking off bargains with that extra income on the bad days. You'll probably get 2 more waves of selling. The realization that we're in a recession, that comes likely after the second quarter. You get negative GDP first quarter, second quarter, likely based on the Atlanta Fed and the rubber duckies that I mentioned. Well, that says people start to snowball in the fear index, and they forget that there's perfectly good bargains out there. And if you're getting paid to wait, take a deep breath and think in terms of 2030. It's not that far away. Wow, what if I reinvest 8% for 5 years? I got 40% just from that. That probably covers the risk. Wave 2, there might be another panic. We're going to deploy the part of the tactical safety. And wave 3, we're building reserves for that while reinvesting in the meantime, because there is a huge part of the market that is way underpriced. Now, we're going to go back to the 70s, right? You think really awkward fashion. You think really bad cars that get 5 miles to the gallon. And you've got Jimmy Carter in office, Nixon before that. That was a great pair. Okay, here, the Dow starts in 1970. You're starting this at about 700 on the Dow. You go to 1,000. First time the Dow reached 1,000, that was 1965. Didn't get permanently back over it till 1981. You're about to see that. This is the worst bear market that I've found in the charts besides the Great Depression. The Dow goes from 1,051 to 577, 50% decline over 2 years. Papa Dean said it was so miserable, he was having to go buy day-old bread at the Mrs. Baird's factory outlet to feed his kids, and he made it through, and he's done quite well, and now he's got his book out. Anyway, this is 838 at the end of 1979. How could you have made money during this period? Right? Because you finally got a gain at the end of the 1970s. You had a nice gain here. 1 is you need tactical safety. 2 is you need a lot of income. If you look at what high yield bonds did, represented by the Lord Abbott Bond Debenture Fund, not a recommendation for your portfolio until you come get a plan, you could have spent 5% a year, reinvested the rest, and finished with a very successful 1970s just from the B-rated corporate bond strategy. They got their nickname junk bonds because the default rate did go up, but it didn't go over 10% during the 70s. B-rated corporates. There's the A team, investment grade. B team, most companies are in the B, and C is distressed, just to give you a bond lesson. All right, 1980s. Wow, that looks pretty good. We had deregulation, lower taxes, lots of productivity from deregulation. That could happen by 2026, by the way. So don't lose sight of deregulation and lower taxes, lower long-term inflation from lower government spending. You've all heard of the crash of '87. Here's the real story. Here's the start of 1987. Here's the finish. If you had just gone on vacation, you'd come back and say, well, not much happened. Whoa, but we all say the crash of '87. Well, you went down about 22% in a single day, but you had gone up, and then you recovered, and so you finished the year about where you started. So when you hear the crash of '87, now you know the real story. All right, this is 1990s. What happened here? We had the PC revolution, we had the internet, which thank you Al Gore, and we had, that was a little sarcasm, and here we go. We go from 2,300 on the Dow at the low, 2,400, to 11,500 in the 90s, and they started paying huge multiples for companies with a burn rate. This is kind of like the electric vehicles, Rivian and Lucid. You measured the company by how long could they survive at the amount of money they're wasting every year. And so it was absolute overpriced insanity. Here's what happened next. Oh, by the way, the lesson in the 90s, you had a technology revolution that was absolutely increasing productivity. A lot like artificial intelligence does today. As a matter of fact, artificial intelligence is the next wave, and it's saving us time each and every day. All right. Whoa, this is not good. This is the crash, the tech wreck, right? All those overpriced tech companies, just like they're doing today, the NASDAQ went down over 80%. It was terrible. And you had a recession, you had 9/11. Then you recovered to a record Dow at 14,000 in 2007. But wait a second. Then the U.S. banking system was rendered insolvent, and boom, the mortgage crisis. Wow, Dow goes to 6,500. And here, finishing at 13,000. So we would say, if we looked at that and that, would say, well, that's a boring decade. You look at these, that's an extreme volatility. And nobody wanted stocks right here. I did a spreadsheet, and I sarcastically called it 20 great companies I believe won't die. I had Whole Foods and Cisco and some really good names in there, and none of them died. And they did great. That's our growth discipline. But nobody wants it down there. They always want it up here. Just like last November and December and January, everybody wanted to pay 100 times earnings for Palantir, and they're wondering, when should I buy NVIDIA? And when everybody's asking the same question, you say, no. That's probably not the right question. I'm going to go where nobody else is looking, and I know I can get paid to wait. That's the key secret. 2009. March 9th, 2009 was the low. They changed a stupid rule called mark-to-market because nobody wanted to buy loans and most people didn't want to buy corporate bonds. We were getting 15% interest in baskets of half-price junk bonds, well-managed, great managers, and we recovered in 9 months to record profits, took the Dow all the way to 2012. There's another lesson. Get paid. Go get a pay raise during all of this turbulence. I'm Spencer McGowan, President, McGowanGroup Wealth Management, your financial weatherman guiding you through the storm. Be sure to subscribe, and I will bring you strategies that we're building into our model portfolios. We serve affluent clients right from the Crescent in Dallas, McGowanGroup Wealth Management. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.